Hello, everyone. It's Ted Bauman here, editor of Bauman Daily, of the Bauman Letter, and of Profit Switch, all of which you can subscribe to, if you like, by clicking on the link above and joining our team. We are rotating our stock picking strategy into new directions in a market that is struggling to find direction. We think we know where it's going to go, but then it keeps hesitating to move in that direction. Underneath that all, I'm convinced that we are headed towards economic recovery and that those are the stocks we want to look at. Today, though, I want to talk about the question of bubbles. One of the things about bubbles is that you really don't know that they exist, or you can't be sure that you're in a bubble until after it's over. In other words, really the best evidence of a bubble is when it pops. But there are some warning signs, and one of the big questions you can ask yourself is, what are those signs, and are we seeing them in our current environment? Ultimately, however, the big question is, what is it that has sustained the big long-term boom in U.S. stock prices really since the great financial crisis? We have seen one of the most epic bull runs since 2008-9 that we've ever seen, and it is starting to get into territory that worries people. So the question is, what has sustained that, and what would happen if some of those elements that sustain it change? That's what I'm going to talk about today. First, though, let's look at the role of the stock market in people's wealth. Here's a chart that shows how important the stock market is in terms of the wealth of the average American household. Basically, we're near 25% of wealth. Now, remember, only half of people in the United States actually hold stocks. So, and of those, almost really all of them are held by the top 10% of households. So nevertheless, that's a big chunk of American wealth tied up in stocks. So the question is, are we in a bubble? Well, there are a couple of ways that you can understand bubbles, and I'm going to pick out three of them that I want to share with you today. The first is something you've probably heard before called the Buffett indicator. Here's a chart that shows the total market valuation of all shares on U.S. exchanges divided by gross domestic product. Essentially, the long-term steady state has been around somewhere between 0.5 and 1. In other words, up until about 1990, the typical relationship between the value of the U.S. stock market and GDP was either about 50% or 100% of it. So they were either half or 100%. Ever since 1990, we've seen a spike. Now, that spike peaked in 2000. It fell again in the dot-com bust. It spiked again just before the great financial crisis and then fell. Since then, though, it has been on a steady upward march. And if you look at the far right-hand side, excuse me, you can see that we are near 3 times. We've never, ever been in that sort of situation. That is the highest level that the Buffett indicator has ever been. Now, why should that worry us? Well, it just simply means that the valuation of stocks is far higher than the actual value of U.S. economic production. And since the value of stocks is supposed to be based on economic production or the future of it, you have to ask yourself whether this is sustainable. Now, here's a next chart that shows another indicator of potential bubble conditions, and that is the role of retail investors. Now, before I show the chart, the Bank of America Global Research recently pointed out that the inflows of money into stocks in just the last 5 months, which is really the tail end of the big 2020 boom, has exceeded the total inflow over the last 12 years. That is an incredible change in the flow of money into stocks. Now, what are the reasons for that? Well, the first one is that retail traders are becoming a big force. Here is a chart that shows that starting in late 2019, or really early 2019, retail trading became the most important component of the turnover of stocks in terms of volume. It's now bigger than quant hedge funds, traditional hedge funds, mutual funds. The only group of traders who trade more than that are high-frequency traders, who, of course, trade their models based on extremely high volumes with low margins. So essentially, that means that in terms of everybody else other than the big high-frequency traders, it's mom and pop, it's you and me, it's those of us who are buying stocks. And that is always a sign that perhaps people are getting too excited about the stock. Now, that's big boom in daily trading has also been reflected in options. Here's a chart that shows options. So we've seen a big increase in options trading. Right now, our volume of options trading is the highest it's ever been. It has jumped one of the highest increases on a quarterly basis since ever, basically, since this record has been kept. Now let's look at one more chart that helps you to visualize the retail frenzy, as they call it. This is a chart that shows the average daily trading volumes of shares. They jumped dramatically at the beginning of 2020, which was before COVID. Okay, so this is something that started before COVID, and then they fell as people began to realize, that COVID was going to be a real threat. And then they started to pull back again, and they continue to be extremely high. So that's the second thing. In addition to the Buffett indicator, we've got a frenzy of retail trading, which is typically, unfortunately, a very good sign that things may be getting out of hand. The last thing is leveraging. Leveraging is when you borrow against the value of stocks in your portfolio. You say to your broker, well, I've got 100,000 in my portfolio, lend me 50. I'll pay you a bit of interest, and I'll see if I can use that 50 to earn that interest back plus some. So you've leveraged your portfolio. Well, here is a chart that shows the total loan balances in retail traders' margin accounts going back to 1997. I've annotated it to show the dot-com crash. It peaked just before that. It peaked just before the financial crisis. It peaked just before the second taper tantrum in 2018 when everybody thought the Fed was going to raise interest rates and started selling off. And look at it now. It is way, way above the trend line. So that red line being the trend line, if you look at how high margin volumes are above the long-term trend line of margin volumes, you can see that we are way up into outer space territory there. Here's a second chart that shows the S&P 500 versus the change, the year-on-year change in margin debt. And again, you can see that the year-on-year change tends to spike every time there is a peak. So you can see the two red dots, one just in the dot-com bust, one before the great financial crisis, and now. And that rate of increase from 2020 to now in terms of margin borrowing is the fastest that I can see. It is certainly extremely high. The critical thing is, look how deep those lines drop after crises, like the red dots. That tells you that margins are being called and stocks are being liquidated by brokers. They don't give you an option. They're going to sell your portfolio in order to get their money back, and that leads to a dramatic collapse in stock prices because it's effectively leveraging. It's leveraging downwards as well as upwards. All right, so those are the three indicators that we could be in bubble territory. Now remember, a bubble is not necessarily affecting all stocks. It typically affects stocks that are extremely popular, and those right now include technology, especially things like EVs, renewable energy, etc., all of which have great futures. The question is, are they too expensive right now relative to those futures? So let's look at a bigger picture that shows what has sustained, the four things that have sustained the great bull market since 2009. Now, the first thing is a chart that shows corporate profits. Now, corporate profits as a percentage of GDP, as this chart shows, have effectively doubled since around 2000. They took a big dive in the great financial crisis, but they've recovered well, and they've spiked big time in 2020, which is bizarre when you think about the fact that we were under COVID lockdown. But fundamentally, there has been a big move upward in corporate profits over time. That's become a new normal. We've gone from a situation where corporate profits relative to GDP held a relatively steady state. They just jumped after 2000, and now they continue to be at very high levels. Now remember, corporate profits are what drive stock prices ultimately. You buy companies because you expect them to profit and you expect them to have more revenues, and that increases their share price. Either just by raising their price to earnings ratios, or raising the price part of the price to earnings, or the earnings part, the denominator, or just by people being willing to pay more for them because they see good things coming in the future. So what are the reasons behind this big increase in profitability in the United States capitalist economy? Well, the first thing is that capital, quite frankly, is beating the pants off labor. As Warren Buffett once said, there is a class struggle going on in this country, and my class, the capitalist class, is winning. Well, here's a chart that shows exactly that. Basically, since 1980, right around the time of the Reagan administration, productivity in U.S. Economic activity has increased significantly, has continued the trend line since the 1950s. But hourly compensation, which used to rise alongside of productivity, has only risen marginally. Now, the difference between hourly compensation and productivity went to corporate profits and to the people who own corporations like shareholders and so on. So that includes many of us. But the bottom line is that it has come at the cost basically of American working people, not just the people, guys behind the counter at McDonald's, but also mid-level managers, everybody who earns a salary. So that's one thing. Capital has dominated labor and has been able to grab the share of the increase in U.S. productivity really ever since the Reagan administration. Now, here's a chart that shows labor's share of income since that period. You can see that basically starting in 2000, it's been going down for a long time, but starting in 2000, labor's share of national income has plummeted. It recovered quite a bit actually during 2020, and that's because of U.S. stimulus packages. Part of national income was redistributed by government in the form of payments, and we began to see a big spike there. But if you can really kind of focus your eyes on that last bit of the line, you can see it's pulling back down again. But fundamentally what this chart shows is that most of the gains that labor saw back in the 50s and 60s in terms of its share of national income have completely evaporated. Now, that's not the only thing that is upholding the profitability and therefore the bull market. The second one is corporate taxation policies. This chart shows the effective rate of taxation on corporations going back to the 1950s. The one is all taxes. That includes basically state taxes. That's the blue one. The other one, the red one, is the red line. Now, corporations always like to moan about taxes. Of course they will. That's in their nature. But the reality is that taxes have dropped dramatically, especially since 2000, and that partly accounts for the huge spike in corporate profits that I showed you earlier, which ultimately underpins the bull market. Now, there's another one which we've talked about a lot this year, and that's interest rates. So here's a chart that shows the relationship between long-term interest rates and the long-term or cyclically adjusted PE ratio, thanks to Professor Schiller. Now, it spiked in 1929. That's the CAPE ratio, spiked in 29, spiked in 66, in 2000, and it's spiking again now at around 36.6. That's the average for all stocks. But the interesting thing is how big the gain in stock valuations has been as that red line has declined. Throughout most of the period, really going back into the late 19th century, there have been periods when the stock prices got ahead of themselves and without interest rates changing it, but generally they always pulled back to some normalized relationship with interest rates. The spike in interest rates in the early 80s brought the stock market down to earth, but ever since then, things have fallen dramatically. So that's the third thing that has kept profits strong. Low interest rates have kept corporate profits strong, and that has helped buoy the stock market. The last thing is actually something a lot of people miss. They don't think about it, and that is the role of the dollar. Starting in the 1970s, the United States adopted an explicit policy of running trade deficits so that the rest of the world could accumulate dollars so that they could use dollars as the main currency for trading in things like oil. That's what we call petrodollars. Now, the petrodollar policy has been deliberate. So, when President Trump talked about trade deficits and talked about it in terms of countries taking advantage of it, he was actually completely wrong. It has been a policy of the United States to run trade deficits so that dollars flood the global market and become the basic reserve currency of the world. So here's a chart that shows since the beginning of, really, go back to 1950s, but look when it starts. It starts in the mid-70s, picks up huge steam in the mid-90s, which is when President Clinton allowed China into the WTO, the World Trade Organization. It's varied over time, but fundamentally you can see that big trade deficits, which means dollars flooding into the rest of the world, have been a big feature of our lives since about 2000, which is, again, when those corporate profits started to peak. Now, here is a chart that shows what's happened to that money. Well, since about 2000, again, foreigners have begun to invest billions and billions and trillions of dollars in U.S. equities. That flood of U.S. dollars out into the market has effectively come back into the U.S. economy via the stock market. Now, What that tells me is that you've got four things to look out for in terms of the if you like, the table legs that hold up this epic bull market that we've had over the last 2 or even 3 decades, because really it goes back to the late 90s. The first one is labor able to recover some ground from capital? Are workers able to regain more of their share of productivity gains going forward? That would mean either through unionization or through legislation or through some other mechanism that would allow labor to grab more of the gains to productivity than capital does. Personally, I think it would be good for the economy if they did, but it could not be so good maybe for the stock market, because again, that's one of the legs of high profits, which means one of the legs of our bull market. The second thing is, are corporate taxes likely to rise? Not just marginally, but to pre-1980 levels. As I showed you with the chart earlier, corporate taxes have been on a huge slide going for a long period, but they are at historic lows right now. Even the proposals to bring them, or the taxation proposals from the Biden administration would not bring us back to pre-1980 levels. A lot of large businesses say they're comfortable with the tax proposals, some say not. But fundamentally, that tells me the fact that there's ambivalence on the corporate sector means that those tax rates are not excessive. What happens if going forward they do become excessive? Not likely to happen, but something to watch out for. The third thing, of course, is, are interest rates likely to return to pre-1980 levels? That means the kinds of interest rates we saw under Chairman Volcker back then, when he squeezed inflation out of the economy brutally, causing a huge recession. Well, not likely. Personally, I don't see a large increase in interest rates on the horizon. They may rise somewhat, but I think that structurally we're facing long-term low interest rates. The fourth thing, of course, is whether foreigners begin to withdraw money out of U.S. equities. Now, they're likely to do that more in response to a decline in the U.S. equity market rather than as a cause. But it could have a leveraging effect if one of these other pillars begins to drop away. So there you have it. Fundamentally, our long-term bull market, which, as I've shown, appears to be somewhat in bubble-like territory, depends on a weak labor in terms of its relationship with capital and its ability to grab a share of national income, low corporate taxes, low interest rates, and a lot of buying by foreigners. If any of those things change or look like they're going to change, then basically party over. Not in all sectors, but in the sectors that have been the biggest beneficiaries of the bubbles. And that doesn't just include equities. It includes things like cryptocurrencies, for example, and all these other speculative assets like NFTs and things like that. So remember, I'm not calling for a crash. I'm not saying, predicting that one's going to happen. I'm just showing you the four things that have sustained this long sustained rise in U.S. Stock prices over the last 20 to 30 years. They're all based on politics. They're all based on choices, and they're based on the relationship between the owners of capital and people who earn wages. If any of that changes, we could be in for a rough ride. This is Ted Bauman signing out. I'll talk to you next week.